lot to say in general on the topic of CfDs, and no doubt that will also be said when we have our discussion session after this. So I'll try not to comment on everything and try and stick to the brief, which is just trying to look strictly from a developer's perspective. What do we think that the new system is going to mean? As basically, I think what I've tried to do, and it won't be a surprise to some of you because you're in the same business, but some of you, I guess, get less close to the craft that is developing these assets in the UK. So I'm going to lift kind of the bonnet a bit and just have a look at what it does to the internal workings and cash flows, risks, etc. for developers. Quickly again, and had a kind introduction there. So what we do, we've been developing solar PV farms ground-mounted in the UK since the solar market kicked off here in 2010-11. Hopefully next week or week after, our 18th project will be connected. So that will take it up to 18 projects in total. So these are still fairly kind of large-scale farms out there. With 125 megawatt. We also run a separate business that does operations and maintenance on solar farms in the UK, acting both as head O&M for whoever the owner is, but also particularly in the first few years when the EPC is typically still retained as O&M, we do a fair amount of subcontracting work. So should any of you be building sites and starting to think about subcontractors, give me a call. Getting to the point of what I'm talking about here, I think before we look at what difference CfDs make, it's worthwhile just taking a quick step back to saying, okay, so what does it look like under the system that we're all really familiar with? There are a lot of annoyingly detailed slides coming here, so I'll try and kind of give you the audio as well, because I'm not sure how much all of you will see. But trying to illustrate this a little bit on a kind of visual front, the timeline of realising a solar PV project in the UK, which you can't see what it all says, but it looks something like this. You start off with finding a site, you go through a bunch of steps along the way where you apply for your grid offer, you secure the land, whether that's just the land on which you build or if it's the cable route or whatever it might be. With Wayleaves, you need to accept and down pay, so you've got it secured, your grid offer. You need to submit your planning application, do all the pretty expensive bits of consultancy work that surrounds that to be able to submit a good application. You need to go through that process, get your consent. You need to start designing how your connection to the grid is going to look, so your grid design submission, and get that approved by the DNO so that you're confident and can go ahead and build. You need to get that planning consent out, and sometime around this level of your timeline, you have what's called a shovel-ready project. And that's at the first point at which one of the developers here in the UK is likely to let go of their project, if that is to somebody who's comfortable taking the construction risk. Otherwise, you hold on for a bit longer, contract an EPC, get it built. Now, we all know this. I think the key point I'm trying to make here, and again, it doesn't come out well in the colours on the slide, but there are tons of things that we all do when we develop, but there are really three key binary success or failure points that happen along this line. You definitely need bankable legals around the land, and not forgetting that you need that for your cable route as well, for example. If you don't get that, your project's dead. It's not going anywhere further. You need a viable grid connection offer that you have secured. It's not enough to have the offer letter. You do have to go ahead, accept it, and pay the down payment so that it's yours. Otherwise, it expires, or you think you're sitting in an offer, but hey presto, you haven't secured it and kind of secured the real rights to this. Well, then it becomes interactive, and then you have kind of another headache. So again, you need to pay the money. And these things need to happen before you know if your project is consented or not, ideally. And that's obviously the last and final, failure success point that happens in the current system. All the other stuff's really important, but these are really the bits important, in the time where a project will then either, die or it will live. I think one thing that's important to keep in mind is that as the developer goes through this and kind of plows ahead and tries to secure its consent, development capital is spent along the way. and you don't know, you cannot know until you sit there with the consent in your hand, which is typically what comes last in this process when you know you can sell a project or not. You have to have undertaken quite a lot of spend in order to get there, right? So this is kind of the below the line, it's kind of cash going out for the developer. One thing that's important to consider is then when you get to the point when you can sell it, and you get to come into there, hopefully with your sales proceeds, into kind of the positive bit of this little mini graph at the bottom, you don't only need to cover the cost of that contract that you have planning consent for and that you're selling, you also need to cover the cost of all the all the costs of the projects that failed along the way. Because inevitably that is what's happening, and that's the art of developing. Not every project, every landowner that you ever spoke to is going to come out the other end with a planning consent. That's not the point. Obviously, a good developer will increase the success probability, but I'd say probably, I'm happy to be contradicted by others out there that do this, but in the UK, given the politicised planning environment, we're typically hovering somewhere around the 50% of success rate in terms of projects you start and that really look viable in terms of its fundamentals and that you actually come out with consents for. So that's obviously worthwhile considering that developers that want to be long-term and actually sustain themselves need to cover those costs as well. And then hopefully you sell your project and you get a little bit of a margin in there as well once you've covered the costs of your successful and failed projects. Now, how does that change with the CFD? And this is kind of the key point. What we have is the timeline stretches out and has some new bits and bobs on it. You now have to enter into an auction where you have to be eligible to enter into that auction at a certain point in time, meaning you need all those key, the bits in yellow to even enter into the auction. So whether you want it or not, if you want to have a go for the final success or failure point that's now being added, i.e. a fourth one, you need to have all the other three. So you need your legals, you need your grid, viable, done, paid, and you need a consent. Now, the obvious point here is that until you know now if you have your fourth binary success or failure point ticked, you need to wait a little longer. So you're kind of housing a project for maybe, let's say, 4-5 months longer, something like that, until a sale is likely to close. So that's kind of effect number one. Given that it's now a fourth point at which, or hurdle at which your project can fail, it's probably fair to assume, and certainly that goes for, I think, many of the colleagues of mine who did put projects into the auction last year, probably the failure rate's going to increase. So if it was 50 before, we're looking at something higher than that. So what you've got is that every successful project that does come out with a strike price now needs to cover that development cost of all those additional projects that didn't make it. Again, that doesn't necessarily make that the whole thing not work, but it's one thing that's worth considering, which puts a pressure on development premiums upwards, not downwards, which I know is clearly where we all want to get to be competitive as a technology in the CfD auction. So if this is now 4 months, the kind of the delay risk in a sense, what that means basically as a developer, you can't cash out here, cash out over here. And that's a bit of a delay, so it kind of slows down recycling of development capital. But the really interesting bit is if you get that planning consent, let's say one day after the eligibility window closes, then it looks more like this. You might have a viable project, but now you have to wait a whole year until the next auction. And it's still obviously not for sure that you're ever going to get a strike price coming out of that auction either. Again, this doesn't say that it doesn't work, but it does say that if you're not a well-funded developer that can have kind of really the development capital and the cash flows to potentially house one of your projects, not for 9 months like you used to, but something that's now coming kind of close to, well, and flipping over the 2-year limit, that's going to be tricky. So what does it all mean? I mean, I think that the points I've tried to make in my slides are the following. It becomes riskier to develop CfD projects because you have an additional success or failure point added in. It does become costlier because each successful project has to carry more unsuccessful ones, and the timeline stretches either a bit of maybe 4 months or so, or a lot if you miss the eligibility window. finally, what do we think that's going to mean? This is very speculative and really keen to hear what everybody else thinks, but what's this going to mean for the industry itself? I couldn't resist doing a small supply and demand of solar PV assets, kind of just going back to micro. So here we go, supply curve. I guess I'm a supplier, the other developers in here are suppliers. The project writes sale price per megawatt on your typical price. Y-axis and on your x-axis, the quantity supplied. Under rocks, let's assume it looked something like this. Demand, well, that's all you buyers, investors out there. And again, this is faint, but it's intentional because we're coming to the real world. This is now the olden days. But this is kind of the old clearing price, let's call it that, and the large number of solar projects that were deployed in the UK, which was great. Now, with the CfDs and all the risks and costs at kind of every level that I just kind of went through, I think it's fair to say that fewer developers are going to have the guts or the ability or the appetite to carry that on. Some definitely will, and we'll see this as a great opportunity, others won't. So you're going to have a classical shift back of your supply curve. And demand, well, I'm really interested to know how that's going to shape up. I guess that's partly the point of this conference. You know, what's going to happen? Is it more attractive to go into CfDs as an investor, less attractive? I'm going to be slightly conservative in saying that that's going to shift down a bit as well, but hopefully not as much as the kind of trickiness for developers. Now, the problem is, as micro theory would have taught you, that scenario would have led to higher prices per megawatt peak for the solar assets developed. And that might happen, but ultimately, the scenario that we all live in now with very cost-pressurized auction environment, it's not very conducive to that. So let's assume that that doesn't happen, because not everyone can increase their costs because everything just got riskier. We need to figure out another way. So let's assume that prices can't get more expensive than they have been in the past. Then what you initially start out with is a bit of a shortage. You've got investors out there who probably would be quite keen to invest in a decent level strike price asset if it can come out, but the game has now gotten so risky for developers that not many people are going to initiate it and actually crank out any assets to invest in. So classic shortage, but that can't really get cleared very effectively by the price. So what could happen? I guess this is the speculation. I would say that there are a couple of things that seem to be emerging as themes. You will have lower quantities of solar being deployed, at least in the initial years. I think that's fair to say, because for some developers, either they'll be too small, not well funded enough, not have the risk appetite or the backing, and they will exit, or frankly just go into, I mean, the development skill set can apply to other assets as well. You can develop other products, you can kind of carry on, you don't have to die, but it might just not be solar ground-mounted large-scale farms that you develop, and that's clearly happening already. Lots of us are looking at other things to diversify into, but with given amounts of resources, that means that a bit less is going to come out, certainly less go in. I think one of the interesting bits that I think is going to bring the supply curve and the demand curve together is you're going to see sharing of risk between the reasonably keen investors that want to see strike prices come out and the developers that do want to undertake this stuff, but it just becomes too risky and might risk breaking their backs. So ultimately, figuring out JV arrangements, or whether it's vertical integration, buying up developers, whatever it is, investors starting developer arms, but ultimately a bringing together of the two so that they can share the risks. I think that's emerging. Or you're just going to have some really risk-loving guys on the developer front who basically crack on and realise that there's a massively interesting upside in developing a large CfD project that you bid into a late delivery year, something like 2018-19. You take a bet on EPC prices, and if you're right, and solar, as it always has to date, massively outperforms on cost reduction, that could be a very interesting asset to sit on at the time. So thank you very much.